Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Corn futures has now completed for us a mirror move of the advance coming into this consolidation on the other side. And we can see a one-to-one correspondence with the recent highs that were made, and we anticipate that this high can perhaps hold for the balance of the month. The market right now appears to be in corrective mode, and it has held very well the 2x1 angle or the green angle on the way up. The market today has made a marginal break of that level, and we're looking at the potential of a break of the 1x1 angle. If and when this market comes through over the next couple of trading days is able to break beyond the 1x1 angle, we could see where the market could correct all the way down perhaps to about the 372 to 373 area. As long as the market holds this 373 number, we think a move back to the upside is plausible. But if the market breaks below this level, a retest of previous lows would at that point be possible. We have shown on several occasions where arc swing tangent lines can form for us projected resistance levels for the markets. Here we can see where the tangent at 351.5 gave us very close to the recent highs, which was also in conjunction with the 180-degree mark at 392.5. With the market having reached this area on our time factor of March 13th, we are now seeing a correction come in and a couple key potential support levels for those corrections to rest at. Somewhere between 378 and 384 are plausible areas for this market to rest. And again, as long as the market doesn't break below 373, we believe that a move to the upside can begin once again. And so the key number that we'll be looking at over the next couple of weeks will be this 373 mark. As would be expected, the December contract looks a bit similar, where resistance for it lives at 413, and we can see a correction coming in for this trade here. One standard deviation above the point of control for the December contract sits at 415.25, and that's the number that we're looking at for good resistance for the balance of the month, potentially for corn. A correction that holds somewhere between 38 to 50% of the range is going to be key in terms of maintaining support. And again, just like the May contract, we anticipate that somewhere in the neighborhood of 395 will perhaps hold, which is one standard deviation beyond the point of control. The volatility-based resistance band for the December contract rests from 404 to 409. Here we can see where the market has been inside of a bit of a consolidation upon reaching that zone. If and when this market breaks back below this point of control number at 395, we do believe that a nice correction to the downside can begin, where we would be looking for the market to hold the 395 number. And as long as 395 is able to hold as good support, we anticipate again that a move to the upside can begin once again after the correction. If the market were to break below 395, a retest of previous lows that perhaps touches somewhere in the neighborhood of 379 or 380 is plausible. For now, we'll continue to monitor the way in which the market operates over the next 2 to 3 weeks. The supply narrative for soybean was very bearish, and upon release of the WASDE report, we can see that the market made a pronounced move to the downside. So even ahead of the WASDE report, we can see where there was a topping formation that was created, and the market came down very strong on the days that followed. We can see a nice bounce here where the market did bounce near one of our point of controls, sitting at 1040. And upon getting to 1040, we can see where the market is finding some stability in this area here in conjunction with one of our time factors. For soybean, it's going to be very important for him to hold somewhere in the neighborhood of 1035 to 1040 in order to make it up to the previous goals that we had discussed in the past. We believe that 1100 is still plausible for soybean, and part of that now is going to be contingent on what's happening in South America with their crops, depending on the type of disruptions that they may see. Given the dryness that we've seen in Argentina, it is plausible that soybean will regain its strength, and so holding key support will be very important going forward. A couple key levels we wanted to bring to your attention. As previously noted, we suggested that the market needed to close above 1067, and in doing so, the possibility of reaching 1086 was very possible. The market did close above 1065, and in doing so, it did reach our 1086 mark. It has since corrected down to the 1-to-1 correspondence at 1048 3/4. Again, if the market continues to hold this 1035 to 1040 number, we like very much the possibility of the market making a run back up to the upside to get to that 1100 mark that we discussed before. In doing so, the market would give us a textbook 5-wave Elliott wave sequence, where we have wave 1 coming in for this initial impulse move. Wave 2 would come in for this shallow correction of about 50%. This move that we're seeing here came in and touched the Fibonacci ratio of 1.618 to 1 of the previous swing. And now we're looking at the corrective phase, and the corrective phase will sometimes give us a small ABC, so we could see a bit of a churn or a choppiness over the next couple of weeks before the market's actually able to make its way back up again. So the key level that we continue to watch will be that 1030 to 1040 mark for the July contract. Interestingly enough, the correction for the November contract was not as deep as the July contract, suggesting that the November contract perhaps has more strength. The key thing for us to watch here is that the market so far has only been able to make it on a 1-to-1 correspondence when we compare the previous swing from the impulse move. So the 1-to-1 correspondence of the initial impulse, unlike the July contract that is at 1.618 to 1, this guy is only at 1-to-1. We need to get to that 1052 1/4 mark if this market is to really find some great legs overhead. But for now, given the shallowness of this move, upon making a couple of closes above 1052, we like the prospect of this market being able to move higher and perhaps touch that Fibonacci area of 1.618 or perhaps even a 2-to-1 correspondence. From this perspective, we can see why this market perhaps has had some trouble near this 1050 mark. We have two overlapping volatility-based resistance bands in conjunction with being at a 360-degree mark of 1049. If and when this market's able to break through this 360-degree mark, at that point we would be looking for the market to perhaps challenge overhead the 1082 mark. Now, mind you, as we look right now, we can see that our volatility bands are actually starting to shift to the downside. That means that the next shift that we're going to see will perhaps sit somewhere right at about this 90-degree mark of 1082, and that's going to be the next key resistance area for this contract as it looks to make its way up higher. Again, the key number that we're looking at was that 1052 from the previous chart, and so if and when this market gets to that 1052 mark, we would look for key resistance at 1082, and from there, maybe a soft correction before it's able to make its way higher. The supply narrative is quite bearish for wheat, and it is perhaps finished with the advance that it had been making for quite some time. Here we can see the initial wave 1, followed by a corrective wave 2, and then it gave us a nice wave 3 that was nice and shallow inside of here. We have our wave 4 coming in for this point low, and then our final completed high looks to have been right in conjunction with our time factor coming in for the March timeline. Upon doing so, we can see here that the market has been in a very nice move to the downside, and the way in which it finds itself, it's possible that this is a flag formation where this market looks to break to the top side, but the way in which it's been moving and the nature of the number of bars that we've seen suggests to us instead that even if it were to break, it probably is going to find some trouble getting much higher than 525. And if it were to move up and then fail near 525, we'd be looking at a nice leg to the downside that perhaps challenges 465. For now, we anticipate that the move up in wheat is completed. So going forward, our cycles simply suggest to us that this market looks to continue moving lower over time and that he in fact is finished with his advance. It was able to recently hit a time factor of March 14th. And the fact that the market doesn't look like he's moving up from this time factor suggests then that this time factor would be an acceleration point where the market can in fact actually continue to go lower and perhaps with greater speed. The next time factor that we're looking at is closer to the end of the month. And so perhaps the market just simply moves down to this area here before he's able to find some legs. And again, we're looking for perhaps a small bounce to the upside or even continued sideways movement before he continues lower. We'll close out with the US dollar. Here on the daily chart, you can see the $91 mark that we talked about the market reaching has finally been met, given the way he's been moving. And over the last 2 weeks, it's really been a very nice sideways consolidation. Now, the market finds itself very close to the $90 mark, which is the 180-degree angle mark here. And we can also see that our volatility bands are narrowing on either side. This suggests for us that the dollar is perhaps going to continue in a range-bound motion, and even if it were to retest this 91 mark, getting much higher than 92 looks to be very challenging. So at this point, we're looking for this market to continue sideways, perhaps retest that $91 mark once again, maybe 91.5, and then from there, start to make its way back down again. Looking at the weekly chart, we can see that in essence that this market is little change given the recent move that we saw after we did our forecast for this low to come in near the $88 mark. And so we can see here that the market is simply range bound or kind of chopping after having made a significant low. And the fact that he's not been able to move much higher given the number of weeks he's been trading sideways also suggests to us that continued weakness is ahead. Over the last 5 to 6 weeks, the range that this market's been able to trade in has been in this very small box. In that same timeline prior to the low that was made, you can see a very big advance. So in the same amount of time, it's been able to actually move only a fraction of the distance that was carried when the market made its drop. This suggests that there are significantly lots more sellers behind this market, and once this consolidation is finished, he'll finally start to make its way back down again and perhaps see another big leg to the downside. We'll continue to monitor the way in which this dollar is tracking. The weekly chart is very important to us in giving us perspective in the long-term horizon, but for now we anticipate continued sideways movement, and once the sideways movement is completed, we're looking for continued weakness to the downside. Thank you so much for joining us for our weekly market update.